London just screamed. Not with a press conference, not with a headline ticker, with a price tag and a borrowing rate that suddenly starts acting like oxygen is running out. Silver didn't climb to $62, it punched through, and within hours it was printing fresh record highs near $64 plus. And if you're wondering why the move feels different this time, it's because the plumbing is making panic noises again. Let's keep it brutally simple. Silver is ripping, gold is getting dragged with it, and the market is acting like someone turned off the tap in the world's most important physical hub. Reuters literally reports silver surged to a record high, with momentum spilling across the whole precious complex. But the real story isn't just price, it's availability. Because when the market gets tight, the first place it shows up isn't your chart. It shows up in a number most people don't even watch. Lease rates. The out-of-metal moment. Why lease rates matter. Lease rates are basically the annualized cost to borrow physical silver in London. So when those rates spike, it's not a cute statistic. It's the market quietly admitting, we need metal now, and we don't have enough willing lenders. Back in the squeeze wave, Reuters quoted a major market voice saying London had a genuine shortage and that lease rates were a little over 11%, calling it phenomenal. Read that again? Over 11% to borrow silver. That is not normal behavior. That's the behavior of a system that's scrambling to keep promises without enough metal sitting idle. Why London is the battlefield? People hear London and think it's just a location. No. London is the over-the-counter heart of the physical silver market, where big players source, lend, swap, and settle. And Reuters described what happens when this heart gets stressed. Tight liquidity in London's spot market. A shortage of available metal helped push prices into dislocation. And then metal starts moving across continents to relieve the pressure. At one point, Reuters reported at least 1,000 tons went into London vaults from the US and China to ease the squeeze. That's not normal arbitrage. That's emergency logistics. That's the market saying, get the metal here. Now, here's the chain reaction, and this is where it gets ugly. Silver price surges shorts and industrial buyers get nervous. They need to roll positions or secure supply. So they borrow metal, short-term, lease market. If lenders hesitate, the borrowing cost jumps. That jump signals physical tightness plus urgency. Reuters spelled out a key point. Lease rates are high when London liquidity is low, especially when demand spikes on top of already stressed flows. So what do banks do when they must borrow? They pay up. And what does that do? It makes paper silver and real silver start arguing with each other. That's when markets get chaotic. Okay, but is it really that bad? Let's not do internet fantasy. No, this doesn't automatically mean the world ran out of silver. What it can mean is more precise and honestly, scarier. London can run short of available lendable metal at the exact moment everybody needs it. That's why Reuters called it a liquidity squeeze in the London hub. It's like a supermarket that technically still has food in the city, but the shelves in your neighborhood are empty and everyone shows up at once. And once panic starts, it feeds itself. Higher lease rates, tighter borrowing, more fear, more hoarding, more just-in-case buying, and price spikes that don't wait for your dip order. When silver tags $62 and keeps moving, this isn't just a rally. It's a regime shift feeling. Reuters. Silver surged to record highs with strong momentum in the metals complex. And that matters because above these levels, risk models break. Hedges get rebalanced. Shorts get forced to defend. And physical players stop caring about the perfect price and start caring about delivery certainty. This is how you get frenetic trading days. Not bullish, frenetic. Now here's what smart viewers should watch next 3 lanes. Scenario A. The pressure valve works. Metal keeps flowing back into London, borrowing eases, lease rates calm, price consolidates. That happened during the earlier squeeze easing phase when fresh inflows helped reduce pressure. Scenario B. The squeeze rotates. Even if London gets relief, stress can pop up elsewhere, shipping delays, regional shortages, sudden ETF, industry surges. Reuters already highlighted how regional tightness can create bizarre dislocations. Scenario C. The market starts paying for certainty. This is the big one. Not paying for silver, paying for certainty. And that's when lease rates become the smoke alarm again. So let me say it clean. Silver hitting $62 isn't the headline. The headline is that the market structure has already shown it can seize up with London tightness, extraordinary borrowing costs, and emergency flows to patch the system. And now price is proving the market is willing to reprice the metal fast. If lease rates start screaming again, that's not hype. That's the system telling you physical matters and everybody just remembered. This isn't a chart story. It's a delivery story.